So, when energy prices start to skyrocket, the obvious move for an investor seems pretty clear, right? But what if I told you the most powerful play isn't at the gas pump at all, but it's actually hidden away in a farmer's field? Today, we are going to uncover a really fascinating and kind of not obvious investment strategy that connects the global energy market directly to the food on your table. All right, let's jump right in. First, we're going to touch on the familiar story, energy prices and inflation. Then we'll pull back the curtain on a hidden ripple effect that flows through a critical global choke point. From there, we'll follow that trail all the way from natural gas to grain, and that's where we'll build out this whole backdoor investment idea. And finally, of course, we're going to get real and weigh the significant risks you absolutely have to consider.
Okay, first up, let's talk about the thing everyone thinks of when energy costs go through the roof.
I mean, for most of us, it's that pain at the pump, isn't it? You see those numbers spinning higher and higher, and you just immediately feel that hit to your wallet. It's a direct, you can feel it kind of consequence of geopolitics and messy global supply chains smacking right into our daily lives.
And in the investment world, the reaction is just as direct. When inflation, driven by these surging gas and oil prices, hits its highest levels in decades, investors tend to flock to what they know. The most straightforward play, the knee-jerk reaction, is to buy the energy giants, the Exxons and the Chevrons of the world. The bet is simple. As the price of their product goes up, so will their profits and, hopefully, their stock prices. This is the front door, the most obvious trade out there.
But that's really just the surface. Let's peel back a layer and see how this whole thing builds into something much, much bigger and way less obvious than just the fuel for your car.
Okay, take a look at this. This is the Strait of Hormuz, and it is one of the most critical and, frankly, volatile choke points on the entire planet. When tensions rise here, the whole global economy just kind of holds its breath, worried about the flow of crude oil. But see, oil is only part of the story. A disruption here creates a domino effect that impacts something even more fundamental.
Now, what's really interesting here is the third piece of this pie. Yeah, sure, a huge amount of the world's crude oil, about 10% of the total supply, and a massive chunk of its liquefied natural gas, or LNG, passes through here. But look at that third slice, urea. That's a key nitrogen-based fertilizer. You see, this isn't just an energy story, it's a food story. And it is a massive food story. Get this, an incredible one-third of the entire world's supply of urea flows through this single, vulnerable passageway. I mean, just think about that. That is a staggering concentration of a resource that is absolutely essential for global agriculture. So what happens when this choke point is threatened? Well, the market reacts instantly. You can see European LNG futures just explode, jumping 60%. Brent crude rises 25%. And look, right there alongside them, urea fertilizer prices spike by 25%. They move in tandem because, well, their fates are completely intertwined.
And this right here is the crucial point. An energy disruption immediately becomes a food cost disruption. It's not a maybe, it's a direct causal link. The very same events that make it more expensive to drive your car also make it more expensive to grow the world's food.
Okay, so this brings us right to the core of that connection, the amazing industrial chemistry that literally turns a fuel source into the very foundation of our entire food supply. To really get this, we need to understand a key term, feedstock. Now, a feedstock isn't just fuel that you burn to power a factory. It's the main raw ingredient that gets totally transformed into the final product. Think of it like this. It's not the gasoline for the car, it's the steel the car is made from. And for modern nitrogen-based fertilizers, the single most important feedstock is natural gas.
So here's the simplified version of how it works. The whole process kicks off with natural gas, which is mostly methane. That's used as the primary source to produce hydrogen. Then that hydrogen gets combined with nitrogen that's literally pulled from the air we breathe using immense heat and pressure. This creates ammonia, and that's the foundational building block for all nitrogen fertilizers. Finally, that ammonia gets processed into more stable products, like the urea we were just talking about. The bottom line, without abundant natural gas, this entire critical chain just breaks down.
So, now that we've forged this incredible link all the way from the gas well to the grain field, let's explore the investment thesis that this hidden connection reveals.
This is exactly where we find our backdoor play. It's an investment that, on the surface, might seem totally unrelated to energy. It's disguised. It looks like an agricultural company, but its profitability is deeply connected to the price of oil and gas.
Okay, let's compare the two side by side.
The direct play, buying a company like Exxon, is a straight-up bet on the commodity price itself. But the backdoor play, say investing in a major fertilizer producer like CF Industries, that's different. In this case, natural gas isn't revenue, it's a primary cost. But, and this is the absolute key, it's a cost they can pass on. Think about it. Farmers need fertilizer to grow crops, period. That demand is what we call inelastic. This gives these companies immense pricing power.
And this just brilliantly illustrates a core investment principle, especially during inflationary times like these. You want to find businesses that aren't just the victims of rising costs, but can actually pass those costs right along to their customers, protecting or even expanding their profit margins in the process.
But, and this is a big but, this is no free lunch. Before anyone even thinks about this kind of play, it is absolutely critical to understand the nuances and the very, very real potential downsides.
First and foremost, you have to remember these are commodity-based companies. That means they are inherently cyclical. They go through booms and busts. And one of the biggest traps for investors is that these stocks can often look their absolute cheapest based on metrics like the price-to-earnings ratio at the very peak of the cycle. When earnings are sky high, the valuation looks low, but that could be a massive warning sign that a downturn is right around the corner.
So let's just lay it all out, the good and the bad. The bull case is clear. You've got an inflationary tailwind from energy costs, you've got that inelastic demand for food, and you've got pricing power that allows for fatter margins. But the bear case is just as compelling. What if fertilizer prices get too high? Well, farmers might just use less, leading to what's called demand destruction. New competition can always pop up and drive down prices. And, most importantly, if energy prices were to suddenly plummet, the entire thesis kind of falls apart, taking away the company's key advantage.
Look, the link between natural gas and fertilizer is just a powerful example of what's called a second-order effect, a hidden connection that just isn't obvious at first glance. It's a great reminder that in this deeply interconnected global economy we live in, sometimes the most important relationships are the ones you really have to dig to find. So the question this leaves us with is, what other critical connections like this are hiding out there in plain sight?